Today I'm going to talk to everyone about investing in registered accounts. So we'll go over our agenda here really quick to explain what exactly a registered investment account is, review of some of the common account types, some considerations for investing in them, and then to some of the meatier tax topics about qualified and prohibited investments, and then all the myriad of taxes that you can stumble your way into. And finishing up with a little bit of comments about CRA audits right now. So what is a registered investment account? Basically, it's some type of investment account that the federal government is giving an incentive for you to invest in for various purposes. There are these five here that we'll be talking about, which you're probably familiar with: RRSPs, RRIFs, TFSAs, and then perhaps the less common RDSPs and RESPs. And for the purposes of this presentation, you might see this acronym there, which is just meant to be Registered Investment Account. So first we'll talk about RRSPs, which are the most common of registered investment accounts. Their big thing is that contributions to them are, of course, deductible from your income. Assuming that you have adequate contribution room. That contribution room, of course, is earned from employment income or self-employment income. There are a couple nice things other than that deduction that everybody is chasing after with this, which is contributions to spousal RRSPs. So you can contribute to your spouse's RRSP and achieve some level of income splitting in the future. The one consideration with that, though, is that the spouse whose RRSP is contributed to, you have to wait 2 years but after the last contribution before they can start taking money out, or else the income will attribute back to the contributor. Those withdrawals are also taxable as ordinary income to the individual. And of course, you have the availability of the home buyer's plan and the lifelong learning plan. The home buyer's plan, of course, they increased fairly recently to $35,000. And they're really great ways to give yourself sort of a tax incentivized, interest-free loan for those particular purchases. Then we have the RRIFs. So the RRSPs will automatically convert it into RRIFs when you turn 71 years old. The hallmark of the RRIF is that you have this 7% minimum withdrawal every single year. So it's the nice thing about this withdrawal is that it's possible to achieve pension splitting with your spouse on that 7%. It's considered pension income. You get the non-refundable tax credit for it. So it can be quite nice. The one point with that, though, is that if you take out any more money above and beyond that 7%, that extra amount will not count as pension income and will not be eligible for pension splitting. So it's important to keep that in mind before you just start taking money out. Similar to RRSPs, the withdrawals are ultimately taxable as ordinary income, and otherwise the account is very similar to RRSPs. TFSAs, this is, of course, the cream of the crop there. The contributions to this are non-deductible, of course, but in exchange, everything that you earn in it is tax-free. So your income, your capital gains, when you withdraw from it, you don't pay any tax. In general, we encourage people to max out their TFSA room as much as possible. But of course, you're limited to that per year limit, which is at $5,500 right now. And if you make withdrawals, the other thing to keep in mind is that you can only contribute back into the TFSA on January 1st of the following year. So you can't just move money or funds in and out of the TFSA as you feel like it. The RDSP, I feel like this is a little bit less well known than some of the others, but it's actually quite good if you have the circumstances that you're able to take advantage of it. Its thing is that you need to have somebody that qualifies for the disability tax credit as a beneficiary of it. Similar to the TFSA, the contributions are non-deductible. there's a lifetime limit of contributions of $200,000, but you get free money from the government. So the way that it works is if you have a high income family, your contributions for the first $1,000 are matched on a one-to-one basis for a federal grant. And if your family income is lower than, I believe it's $93,000 per year, you will get matched on a 3-to-1 or a 2-to-1 basis on those contributions, up to $3,500 per year. Regardless of your family's income level, the lifetime limit for the extra money that the government will kick in is $70,000. But that's pretty good. I mean, you get that for effectively just choosing to put it in account A instead of account B. So, if you have somebody that you know it's eligible for, it's definitely something to consider. And there's also no limitations on the spending by the beneficiary, unlike the RESP, which we'll talk about next. So similar to the RDSP, the contributions to this are non-deductible. There's a much lower lifetime contribution limit of $50,000. The hallmark of this one is the Canada Education Savings Grant, which will give you up to $500 per year. You can open a RRSP for every child, it's just another good way to go and get free money from the Fed. I mean, what investment are you going to be able to make that'll give you a 20% guaranteed ROI every single time that you go and put money into it, right? Even if it's not a very large amount of money, it's something that for sure you should consider, especially with the nature of how often people need to go to post-secondary for just getting into the job market these days. The one caution that I'd give with it, though, is that the CESG is repayable if the RRSP collapses without use by the beneficiary. So if they end up not going to a post-secondary institution, you end up having to repay the government for the extent of that grant. So some other overall considerations, the income and capital gains that are in these investment accounts, they accrue on a tax-deferred basis, which can mean faster growth as compared to a taxable investment portfolio. So to the extent that you're able to put money in and that's important to you, then that can be quite important, particularly if you have to liquidate some of your stock in order to pay your annual tax liability. But one of the not so good things that I don't think a lot of people think about is that funds that are in these registered accounts, they will lose their income tax character. So for example, if you have funds that are meant to earn capital gains and you have that in your RRSP, you'll be paying tax on a 100% rate instead of the preferential 50% rate that you otherwise would be paying for those capital gains in a taxable investment portfolio. So it's definitely something to think about in terms of what product mix that you have in those registered accounts. And with that in mind, for just overall recommendations for the TFSA, you would want to put whatever is going to make the most amount of money, because of course all of that would be tax sheltered. But for non-TFSA accounts, what I would suggest is, to the extent that you have interest-bearing assets as part of your portfolio, to have those be in the registered investment accounts, because the opportunity cost is a lot lower. So what can you invest in a registered account? There's two criteria. They sound very similar, but they're not quite. One of them is that the investment must be a qualified investment, and the other is that it must not be a prohibited investment. So the qualified investment relates more to the type or the nature of the investment. So that's like, is it shares? Is it money? Is it debt? The prohibited investment rules, those relate more to the relationship that you as the plan holder have to the investment. Are you too closely tied to the thing that you want to go and put in? And the other key with these is that this is an any point in time test. So literally any time in the year, somebody should be able to point to every single investment that's in your registered investment account, and it should both be a qualified investment and not be a prohibited investment. And if at any time they don't meet that criteria, that's where you can have some of these taxes apply that we'll talk about in a short while. So qualified investment, this is a lot of stuff that you would expect to be there, money, deposits, GIC, public company shares, options, mutual funds, bonds, etc. It's all fairly normal stuff. There are some more uncommon investments that are allowed to be put in there, but it's a little outside of the scope of this presentation. Prohibited investments, you can't put any personal debts in there. So if Bob owes you money, you can't put that into your RRSP, unfortunately. The more common thing that will throw you offside for this prohibited investment is debt, shares, interests in corporations, partnerships, where you're considered to have a significant interest, which we'll talk more about in the next slide. And this, of course, also includes stock options. So it's not just shares, but the right to acquire shares or debt or interest or so on. Significant interest, this is these are very specific tax terms, and it's important to drill down into them because this is where you can get caught offside. Is that it's 10% of any class of the shares of a corporation, or in the case of a partnership or trust, 10% of the fair market value because they don't have shares. The really nasty thing about this is that it includes all the shares held by those people who are at non-arm's length from you. So non-arm's length, if you scroll down the slide there a little bit more, it is every person that is related to you by blood. Now, that is also a really specific tax term. It doesn't include cousins, it doesn't include your aunts, uncles, nieces, nephews, but basically everybody else is fair game. So your siblings, your grandparents, your parents, your kids, your grandkids, if any of them own shares in that same class of shares that you have an interest in, and that collectively throws you above 10%, then you can be offside. And we've seen that catch some people even innocently. It's definitely something to watch out for. But the other one is that it doesn't necessarily need to be people who are related to you by blood. It can be fact specific. So if you have a very long-term business partner that, your families vacation together, you do everything together, it's very unlikely that CRA would consider you to be acting at arm's length from one another. But it doesn't even need to be that specific. What if you have just a preferred business partner that you cut good deals to that you would not cut to somebody who walked in off the street? There's a possibility that you could be considered to be dealing at non-arm's length with those people too. So you definitely want to make sure that you're careful as far as those sorts of investments go. I thought we would go through an example and pick on two of our favorite people, Bob and Bill. And Bob and Bill, we'll say that they're the founders of XYZ Explorations, Inc., a company that's listed on the TSX. And each of Bob and Bill owns 6% of the only class of outstanding shares. Bob and Bill are not directors of the company, and Bill decides that he wants to save some money and he wants to contribute these shares into his TFSA. So if Bob and Bill are at arm's length from one another, is this okay? Can Bill contribute these shares to his TFSA? And the answer is yes. You can't be held responsible for what happens to people that you don't really know or deal with, so that's all fine. But what if it turns out that, Bob and Bill, they've been brothers at heart, but what if they were babies separated at birth and they were secretly brothers this whole time and they didn't find out until after Bill already contributed to his TFSA? So Bob has 6% in a taxable investment account and Bill has it inside his TFSA. Does that throw them offside? And it does. It would be a prohibited investment in that case because they're related by blood. Third example, what if Bill is in fact a director of the company? And the question there is a matter of fact. It's how much influence would Bill have as a director? Could he still be considered to be dealing at arm's length from the company? And the answer is, like most things in tax, it depends. And then the last one here is, what if XYZ Explorations gets delisted? So it's no longer a public company, but a private company. So let's talk about that in a little bit more detail. So private company shares, they need to go back to that prohibited investment test. It needs to be on a non-arm's length basis, and that less than 10% test, which prohibits a lot of private company investments. So your personal holdcos, those are never going to be going into a RRSP. And if you're considering reducing your share ownership, so that it could qualify to go into a TFSA or RRSP, there are things that you want to consider, like the loss of control, what the sales price is, whether you have any sort of weird side agreements for the people that you're selling the shares to sell them back to you later, or to give you money for it and under the table. Those are not good things. The other one is that for private company shares specifically, is that it needs to be a specified small business corporation. So what that means is that 90% or more of the assets in the company need to be in an active business carried on primarily in Canada. So it can't be just an investment holding company that has more shares or isn't in an active business. It also must be a Canadian corporation. It cannot be one that was continued from a foreign jurisdiction, and it can't be controlled by non-resident persons. So as long as all of those things are met, you could put these private company shares in. Oftentimes investment advisors will ask for an opinion letter to go and confirm that these requirements are met. But in theory, as long as that's all fine, then you could put private company shares in. So let's start talking about a couple of the taxes. They're pretty brutal, honestly. So the non-qualified investment tax, we talked earlier about that the investments need to be a qualified investment. So if it's not a qualified investment, this tax will apply, and the tax is 50% of the value of the investment. So it's quite a punitive asset tax, and they rub a little bit of extra salt in the wound and make you file an extra tax return to go and report this egregious tax. The one nice thing about it, though, is that it is refundable as long as you're basically acting in good faith. So if this tax arises and then you realize, oops, my bad, this was in fact a non-qualified investment, and then you get rid of it within the same calendar year, and there aren't other circumstances where you probably should have known better, then you're able to get a refund of this tax. But that second point there, where it's unreasonable to conclude that the plan holder should have known better. For example, me as a tax accountant, I should know better if there's something that's going into my RRSP. I will never be able to rely on that excuse if something happens. People who are working actively in the markets, it's probably unreasonable in that kind of circumstance too. People actively in banking. So just something to go and keep in mind there. Advantage tax. This one's definitely the worst of them. So you are reading that correctly. It is a 100% tax rate. The purpose of it is basically to completely discourage the particular types of investments that are seen by CRA as offensive. And the tax is 100% of the fair market value of the benefit, the amount of the debt, or the registered plan strip. The long and short of it is essentially, how much money did you make? We're taking all of that money away as tax. It can be waived at the discretion of the CRA. Definitely not something that I would count on, but it is possible if you somehow innocently stumble into it. And with that in mind, we'll talk about swap transactions briefly, and this is one where advantage tax can be applied. So a swap transaction is essentially if you have property that's within a registered account and property that's outside of an investment account or a registered account, and you don't want to deal with pesky things like contribution rooms and whether you're allowed to contribute it into the registered account or not. and you just tell your investment advisor, hey, let's switch these two things. They're worth the same. Who cares? It's fine. CRA does not consider that to be fine. If there's any sort of income that you make from that swap transaction, it'll be subject to the advantage tax, and effectively any income that you gain from it will be garnished. So I would not suggest engaging in such transactions. It doesn't seem very worthwhile at all. The one thing that it can be used for, though, is if you somehow find yourself with a prohibited investment in a registered account, you can do a swap transaction to remove the prohibited investment so that you're not essentially penalized for the contribution room portion that prohibited investment takes up. Over contribution tax, so this will most commonly apply to RRSPs, but it does apply to all registered accounts. It's a 1% per month tax on the amount of the excess contribution. It can definitely add up very quickly over time. It's payable 90 days after the end of the calendar year in which there's an overcontribution. As many of you are aware, the RRSPs do have a overcontribution threshold of $2,000 as like a grace room. But the important thing to note is none of the other registered accounts have that. So if you're $50 over on your TFSA contribution limit, you are subject to an overcontribution tax on that. There's no leeway that's given to it. So for that reason, it's very important to make sure that you know what your contribution limits are. And then of course you have to file this extra tax return, the T1 OVP, to report your tax liability to CRA. So just some other cautions to think about. This might seem obvious, but you can't borrow money from within a registered account. You can't take out a loan. The main reason for that is if you were able to, it would effectively create a tax deduction where you aren't able to go and take one. So for example, if I were borrowing money conventionally and then inserting that into a TFSA, I would not be able to take a deduction on the interest that I pay on that loan because the TFSA isn't earning taxable income for me. But if I had this for an RRSP and I was paying interest from within the RRSP, then when I withdraw money later on, I'm never drawing into income that interest expense that was within the registered account. So those are prohibited. You can't carry on a business within a registered account. The most common thing with this would be a day trading type of activity. So if you have a lot of trades that go on in your TFSA, that's something that you should be very cautious about, especially if your day job is involved in trading or similar sort of activities. CRA could definitely come after you. Though they seem to be okay with it within RRSPs and RRIFs because ultimately you're taxable on the full amount when you take it out anyway. The other thing to keep in mind, this is something where I see people go wrong quite frequently, is contributions of shares in kind. And in kind means that you're not selling shares when you put them in, and putting in cash. You're taking your shares of XYZ Explorations and putting it directly into a registered account. So what happens with that is that any accrued capital gains are immediately recognized on that contribution. So you don't have the cash to go and pay the tax for it, but you have to pay the tax on it anyway. And then the real kicker is if you contribute something that has an accrued capital loss, that loss is actually denied in full. And this is treated on a share-by-share basis. So if you contribute 10 different shares into your TFSA, some of them have gains, some of them have losses. It's not that we take the net and then deal with that net on this basis. They will tax you on all of the accrued capital gains and deny all of the accrued capital losses on a piece-by-piece basis. So very important to keep that in mind. And then just to finish up here, we'll talk just briefly about CRA Audit Trends. Definitely the strong focus has been on TFSA accounts. Particularly, they're looking at people who are very successful in their TFSAs and have a lot of extra contribution room. You can basically guarantee that you have an audit if your contribution room is in the 7-figure range. Then they're also going to be targeting or have been targeting private company and unlisted shares, non-arm's length relationships. If you have father and son who have contributed to the same stock and have gone offside on that prohibited investment, and also the day trading business side of things. Those are also fairly recent audit topics. So just some things to go and keep in mind for investing in registered accounts as far as what CRA might be looking for.